Welcome back to the Wall Street Podcast. Today we're doing a deep dive into some key reports from the Wall Street Journal, specifically from Thursday, August 7th, 2025. Our goal here is to really pull out the crucial insights on U.S. trade policy shifts, what's happening with corporate earnings, and that ongoing AI talent race. So let's start with trade policy. The journal's detailing President Trump's latest tariff moves. What are the main points we need to know?
Well, the reports show a pretty significant step up. The president announced a 100% tariff on all chips. That is, unless firms invest domestically.
100%. Wow. But there are exceptions.
Yes, exemptions are being granted. Apple's mentioned as one example. Also, India is facing an additional 25% tariff.
Okay, why India specifically?
It seems linked primarily to their Russian oil purchases. That brings their total tariff rate up to 50%.
And something else about small purchases.
Right, and this is key for consumers. The de minimis exemption, the one that lets small international online orders come in duty-free.
Under the threshold.
That's ending August 29th. So new tariffs will apply to those small items directly.
So potentially hitting everyday online shopping. And how are trading partners reacting?
They are actively lobbying for waivers. The EU, Japan, South Korea, even Cambodia are mentioned as pushing back, trying to get exemptions from these levies.
Okay, so a lot of moving parts. New tariffs, higher rates, exemptions ending.
Yeah.
What does the journal say this means for, well, bringing manufacturing back to the U.S.? Is reshoring actually happening effectively?
The analysis in the journal suggests, broadly speaking, no. Tariffs haven't really sparked widespread reshoring.
Why not, if the cost of importing goes up?
Economists point out the rates often aren't quite high enough to fully cancel out other global cost advantages and, perhaps more importantly, the unpredictable nature of the policy.
The constant changes.
Exactly. It makes companies hesitant to commit the huge long-term capital needed for, say, building a new factory here, even with almost $2 trillion pledged this year for manufacturing projects.
So stability is maybe more valuable than the tariff incentive itself.
It appears that way. Businesses seem to really value predictable policy for those big investments.
Okay, let's shift gears then. Beyond trade, what about the corporate world? What are earnings telling us? McDonald's, Disney, and what's going on with AI?
Sure, McDonald's reported global same-store sales up 3.8%. That beat estimates.
And the takeaway there.
It really highlights their focus on value. They're trying hard to bring back lower-income consumers who might have pulled back.
Makes sense. And Disney?
Disney raised its profit forecasts, specifically for streaming and its experiences, like parks. So, good momentum there.
But not everywhere for them.
No, their traditional TV business is still facing headwinds, still struggling a bit.
And the AI angle, this talent race.
Right. Separately, Microsoft's AI chief is reportedly going hard after top talent from Google's DeepMind.
How? Just offering more money?
Higher pay, yes, but also pitching a more startup-like environment, trying to lure them away.
Interesting. And Reddit, they had some news too.
They did. A 78% jump in revenue. That's significant. Part of that seems to be coming from new AI licensing deals.
Licensing their data.
Exactly. Deals with companies like OpenAI and Google were mentioned.
Okay, quite a bit happening on the corporate side. If we step back and look at the market overall, that surge in the Magnificent Seven stocks, how does that fit into broader market trends? What's the journal's take?
Well, there's a study cited in the journal that's pretty striking. The top 10 stocks in the S&P 500 now make up 38% of its total value.
38%. That sounds high.
It is. It's a concentration level we haven't really seen since the dot-com bubble era.
And what happened back then? Or what does history suggest might happen now?
Historically, during periods like this, the other stocks, the market's smallest 490 companies in the S&P 500, have actually significantly outperformed the top 10 over the next 5 years.
Really? So the big guys don't just keep running away with it?
History suggests not necessarily, not over the longer term. For investors, it implies maybe looking beyond the giants, perhaps finding opportunities in those smaller, currently less favored S&P 500 firms. Diversification might be key.
That's a fascinating historical parallel. Let's bring this down to the individual level. How do all these shifts, trade policy, corporate moves, actually impact you, the listener, in daily life?
The most direct impact will likely be from those tariffs, especially the end of the de minimis rule. Soon, you could see direct tariff bills on small things you order online from other countries.
Can you give an example?
Sure. Imagine ordering, say, Brazilian coffee online. You might suddenly see a 50% tariff added right onto your bill before you check out.
Ouch, so it's not just hidden in the price anymore.
Potentially not for these smaller online buys. It contributes to rising prices overall, of course. Imported goods, household items, furniture, electronics, they're already up about 3% due to tariffs.
And the Fed acknowledges this.
Yes, the Federal Reserve has basically said someone has to pay for the tariffs. It underscores that this eventually hits your purchasing power, even if indirectly sometimes.
So we see the direct hit on imports. And looking back at the corporate earnings, what stands out to you about how these wider economic shifts show up in everyday consumer choices?
I think McDonald's focus on value is really telling. It shows that lower-income consumers, especially, are feeling the pinch and cutting back on discretionary spending.
Even on relatively cheaper things like fast food.
Right. It suggests a broad sensitivity to rising costs. Wages for many just aren't keeping pace with the inflation that's partly fueled by these kinds of economic pressures, including the tariffs.
So it's a clear signal these big picture policy shifts and market trends really do filter down.
Absolutely. They influence individual spending habits and choices directly.
So as these trade policies continue to evolve and the tech battles, especially in AI, keep heating up, it's clear this interplay between government, companies, and consumers is incredibly dynamic. It's definitely worth considering how these interconnected forces might reshape your own economic decisions, maybe even your investment strategies, in the months ahead.